Welcome to this explainer. To the average observer, Moody's probably just looks like your standard financial data provider. But underneath that surface, well, it's actually one of the most powerful business models in modern finance. It operates as this invisible, highly lucrative certification toll booth that literally monetizes trust in the global debt market. So today, we're going to look at the exact mechanics of how Moody's turned market credibility into a multi-billion-dollar cash-generating machine. Okay, let's dive into this blueprint. We're going to break down this institutional-grade machine in 3 simple steps. Section 1 covers the rating tax and the moat. Section 2 will look at their 2 core engines, MIS and MA. And finally, Section 3 will weigh their intrinsic value drivers against some pretty systematic risks. All right, Layer 1, the rating tax and the moat. Let's establish exactly why debt issuers willingly pay a toll booth fee just for investor trust. The core of Moody's power is something called the rating tax. Now, this isn't a legal tax levied by a government, right? It's a market toll. It's literally the cost an issuer pays to buy recognized credit certification. Think about it. When a company wants to borrow money, they're basically asking strangers like pension funds or mutual funds to lend them capital. Without a recognized rating, an unrated borrower's road to capital is narrower, it's slower, and honestly, it's just a lot more expensive. But if they pay the Moody's toll booth, they get a market passport. It translates their complex default risk into a standardized language the whole global debt market understands. So why does this matter to us? Because whether it's your personal pension fund or a local city building a bridge, they're relying on this exact toll booth. Trust, as it turns out, is a whole lot cheaper than uncertainty. So how did this massive moat actually develop? Well, it definitely didn't happen overnight. Back in the early 1900s, John Moody was just publishing these basic manuals of securities information. But in 1909, he had a massive breakthrough. He introduced bond ratings for railroad securities. He realized investors didn't just want raw data. They desperately needed interpretation. Now, initially, investors paid for this research. But as markets grew, this kind of ironic free rider problem popped up, where everyone was benefiting from a published reading without actually paying for it. So the industry logically shifted to an issuer's pays model, meaning the borrower pays the fee. And in the modern era, this evolved into full-blown regulatory capture. The SEC officially recognizes certain agencies as NRSROs. That regulatory stamp turned Moody's from a simple subscription product into an absolute impenetrable market standard. And this brilliantly illustrates the reality of that moat today. Just look at the 2024 SEC statistics. There were about 2.15 million outstanding credit ratings. S&P, Moody's, and Fitch, the big 3, they account for an absolutely staggering 93.38% of all those ratings. Moody's alone holds over 674,000 of them. We're talking about a highly concentrated oligopoly here, and honestly, the sheer scale of dominance is almost absurd. Any new rating agency faces this brutal circular problem. Investors won't rely on a new agency because issuers don't use it, and issuers won't pay for it because investors don't rely on it. That loop fiercely protects the big guys. So, just to quickly summarize our first layer here. The rating tax is the market toll for liquidity. The moat is heavily protected by both deep reputation and strict regulation. And the market itself is dominated by an oligopoly, where the big 3 command over 93% of the space. Moving right along to layer 2, the 2 engines. We'll look at MIS and MA. To understand exactly how the Moody's machine translates this moat into extreme cash flow, you've got to realize that Moody's isn't just one business. It's actually powered by 2 distinct, highly synergistic engines. On one side, you have Moody's Investor Service, or MIS. That's the credit rating agency. It's a high-margin but cyclical toll booth tied directly to debt issuance. On the other side, you've got Moody's Analytics, or MA. This is the recurring revenue software, data, and risk platform. Analytics essentially operationalizes the credit intelligence that the rating side produces. The brilliance here is that the cyclical, highly lucrative toll booth of ratings funds the sticky, recurring software layer of analytics, and together they both reinforce the overall brand trust. Now, what's really interesting about this is the sheer scale of the operation. For the full year of 2025, Moody's reported a massive $7.7 billion in total revenue. That breaks down to $4.1 billion from the MIS rating engine and $3.6 billion from the analytics side. This shows a beautifully balanced financial footprint. I mean, they produced $2.6 billion of free cash flow in that year alone. The best part for them? They don't need to fund the borrowers. They just get paid to judge them. If we zoom into their first quarter 2026 performance, the margins are where the true power of this toll booth logic absolutely shines. Look at that MIS adjusted margin, a staggering 66.7%. That was generated on the back of more than $2 trillion of rated issuance in a single quarter. The fee they charge an issuer is tiny compared to the billions being raised, but since the product is just information and not physical inventory, their margins are just off the charts. When you blend that with the 32.5% margin of the analytics business, you get a total company adjusted operating margin of over 53%. Just imagine running a business where you keep more than half of every single dollar, purely for giving your recognized opinion. And while the rating side provides that massive margin, the analytics side, well, that provides the stability. In that same first quarter of 2026, Moody's Analytics reported an annualized recurring revenue of $3.6 billion, alongside a 95% retention rate. 95%. There is no way you look at that and don't see the incredible stickiness of their subscription workflow business. Once banks, insurers, or asset managers integrate Moody's models into their daily systems, they literally just do not leave. So to recap the mechanics of Layer 2, MIS acts as the cyclical Tollbooth, bringing in $4.1 billion in 2025. MA acts as the recurring software anchor with $3.6 billion. Together, they generate company margins consistently north of 50%, producing massive free cash flow, like the $844 million we saw in Q1 2026 alone. It's an incredibly capital-light cash machine. Let's move to our final section, Layer 3, Value and Risks. Let's see how this builds into their intrinsic drivers. Here, we really need to weigh the forward-looking value of the company against the very real, existential market threats out there. The intrinsic value of Moody's is pushed forward by a few deeply entrenched systemic drivers. First, global debt issuance expansion. Think of debt growth as this constant ocean current, and the persistent refinancing cycles are the waves that just keep bringing borrowers back to the market again and again. Add to that their incredible pricing power. Because the rating fee is so small relative to the total cost of debt, the value they deliver vastly exceeds the direct fee. And finally, you have this steady compounding of the analytics ARR, giving the company a super reliable software-like growth trajectory. But this system is not without its controversies. The most glaring structural conflict is the issuer pays model itself. Think about it. The issuer wants a favorable rating, but the issuer is also the one paying the agency. That naturally creates a conflict of interest that honestly never truly disappears. Now, to be fair, Moody's rigidly manages this. They use strict committee methodologies, internal compliance, surveillance, and heavy regulatory oversight. But the risk is always there. If the broader market ever starts believing ratings are being systematically softened just to please the paying issuers, the foundation of their entire moat would absolutely crack. Beyond the structural conflicts, there is an existential technological threat looming: AI commoditization. Sure, artificial intelligence can definitely help Moody's make its data easier to use and better integrated. But the systematic risk is this: what if customers begin to believe that generic large language models can eventually replicate proprietary credit intelligence? If that happens, Moody's incredible pricing power could seriously weaken. Their defense relies entirely on data quality, regulatory trust, and maintaining their spot as a permissioned, certified layer inside institutional workflows. So, summarizing Layer 3, it's a really fascinating balance. Global debt growth is countered by the cyclicality of issuance. Their astonishing pricing power is shadowed by the issuer pays conflict. And that beautiful compounding of software revenue is racing right against the threat of AI disruption. At the end of the day, institutional trust remains their absolute indispensable asset. And that brings us to the verdict. So the crucial point we really need to take away is perfectly captured here. Moody's doesn't actually sell certainty. A rating is just an opinion, right? It's not a guarantee of repayment. But what it actually sells is recognized credit judgment. And in the massive, complex global debt markets, recognized judgment, a shared, standard language of risk, can be almost as valuable as the capital itself. That is the true nature of this certification Tollbooth. Which leaves us with one stark, lingering question. Will artificial intelligence eventually commoditize the very trust that Moody's has successfully monetized for over a century? Or are market convention and regulatory capture simply too strong for algorithms to break? It's a fascinating question that challenges the future durability of moats in the AI era. Thank you so much for joining me for this explainer, and keep questioning the systems that run our markets.